This is Margin Machine, where we follow the money behind AI. Anthropic is reportedly burning through $3 billion a year. And it still might not be enough. By the end of this video, you'll know exactly how a company losing that much money became worth $61 billion, and why the obvious answer, that it's just hype, is completely wrong. Welcome back to another money trail. Let's start at the beginning, because where a company gets its first money tells you everything about what it's actually building. Anthropic was founded in 2021. Not by outsiders. By insiders, specifically, former OpenAI executives led by Dario Amodei and his sister Daniela. They didn't leave to build something faster. They left because they thought OpenAI was moving too recklessly. That ideological split mattered to investors. Within months, Anthropic raised $704 million in its Series B. Then $450 million more. The pitch wasn't just a better chatbot. It was a safer one. And safer turned out to be a word certain investors, especially those nervous about regulatory blowback, were willing to pay a serious premium for. But here's the part nobody mentions: safety as a brand position isn't free. It requires a specific kind of research that doesn't ship features. It costs money before it makes money. And that cost structure is unlike almost any other AI company in the market. So where does $3 billion a year actually go? $3 billion a year sounds abstract. Let's make it concrete. The single largest cost is compute, the raw GPU power needed to train and run large language models. Training one frontier model reportedly costs hundreds of millions of dollars in compute alone. And you don't train it once. You iterate. You fine-tune. You run safety evaluations that themselves require massive compute. Then there's talent. Anthropic employs some of the most sought-after AI researchers in the world. These aren't $120,000 a year engineers. Top AI researchers command $500,000, $800,000, sometimes over $1 million in total compensation. Multiply that across hundreds of researchers and you're already deep into 9 figures before you've written a single line of product code. And then there's the cost that doesn't show up on most people's radar: interpretability research. Anthropic spends real money trying to understand what's happening inside AI models, not to ship faster, but to understand the machine they've built. That's expensive science with no immediate revenue attached. So the question becomes, where does the revenue come from to offset any of this? This is where everyone gets it wrong about Anthropic. People assume it's a pure research lab, basically a non-profit wearing a startup costume. It's not. Anthropic has a real product, Claude, and Claude has real enterprise customers paying real money. Claude is sold through API access and through Claude.ai subscriptions at $20 a month for consumers and $25 to $30 per seat per month for teams and enterprise tiers. But the consumer numbers aren't the interesting part. The interesting part is the enterprise pipeline. Companies integrating Claude directly into their workflows, legal tech, customer service platforms, internal knowledge tools, are paying significantly more. Some enterprise contracts are reportedly worth millions of dollars annually. And Anthropic reportedly crossed $1 billion in annualized revenue in 2024. That's not profit. But it's proof that someone is paying. If you saw our video on the startup where law firms pay $288,000 a year for AI, you already know where this is going. Enterprise is where the real revenue hides. Would you have taken equity in Anthropic at a $61 billion valuation before it turned a profit? Tell us in the comments. Because the gap between $1 billion in revenue and $3 billion in costs is still enormous. And the way Anthropic is trying to close it leads somewhere most people didn't see coming. In 2023, Amazon announced it would invest up to $4 billion in Anthropic. Then in 2024, it committed the full amount. That's not a standard venture investment. That's a structural partnership. And the structure matters more than the dollar figure. As part of the deal, Anthropic agreed to use Amazon Web Services as its primary cloud provider. Which means a massive chunk of that $3 billion in annual compute costs flows directly back to Amazon as a customer. Amazon gets Anthropic's cloud spend. Anthropic gets access to Amazon's custom Trainium chips, a cheaper alternative to NVIDIA GPUs, and integration into AWS Enterprise Sales Machine. It's a circular money flow. Amazon funds Anthropic. Anthropic pays Amazon for compute. Amazon sells Anthropic's models to its enterprise customers through AWS Bedrock. The margin on that last part, AWS Bedrock, where businesses access Claude through Amazon's platform, goes to Amazon, not Anthropic. So the question becomes, who actually captures the upside when Claude gets adopted at scale? And the answer is more complicated than the headline suggests. Because Google did almost exactly the same thing. And that's when it gets weird. Google has also committed up to $2 billion to Anthropic through Google Cloud. Anthropic uses Google's TPU infrastructure. Google distributes Claude through Google Cloud's Vertex AI platform. Anthropic now has two of the three largest cloud providers as both investors and customers and distribution channels simultaneously. On the surface, this looks like Anthropic winning. It raised nearly $6 billion from two tech giants, secured cheap compute, and got enterprise distribution without building its own sales force from scratch. But follow the money one step further. Every time a company accesses Claude through AWS Bedrock or Google Vertex AI, the cloud provider takes a cut. Anthropic built the model. Anthropic trained it. Anthropic pays the researchers. But the infrastructure layer, the part that actually touches the customer's credit card, is owned by Amazon or Google. This is a pattern we've seen before in tech. Build the content, let the platform collect the toll. The question is whether Anthropic can eventually build enough direct distribution, enough companies paying Anthropic directly rather than through a cloud middleman, to shift that margin back in its favor. And they have one more card to play. So let's do the math that the $61 billion valuation implies. At roughly $1 billion in annualized revenue, Anthropic is valued at around 61 times revenue. That's not a typo. For context, mature software companies trade at 5 to 15 times revenue. Even high-growth AI darlings rarely push past 30. 61 is a number that only makes sense if you believe one of two things. Either Claude becomes the default AI layer for enterprise computing globally, a multi-hundred billion-dollar market, or Anthropic safety research produces something that creates a regulatory moat, where governments mandate safety-certified AI for certain applications and Anthropic is the only certified vendor. We follow the money here every week, subscribe so you don't miss the next trail. Because right now, the $61 billion bet is essentially a wager that one of those two outcomes arrives before the cash runs out. And based on the current burn rate, Anthropic has roughly 2 to 3 years of runway before it needs either profitability or another massive raise. The clock is running. Here's where we land. Anthropic is not a typical startup and it's not a non-profit. It's something genuinely new, a company whose cost structure is built around a theory, that safe AI is worth more in the long run than fast AI, and whose revenue model depends on whether enterprises agree before the money runs out. The $3 billion annual burn isn't reckless spending. It's a very specific bet on research-led defensibility in a market where everyone else is racing to ship. Whether that bet pays off depends on something no balance sheet can show you yet, whether safety becomes a purchase criterion for enterprise AI, or whether it stays a marketing word. But here's what we know for certain. Amazon and Google have already collected their downside protection. The cloud deals guarantee them revenue regardless of whether Anthropic wins. The founders believe in the mission. And the investors believe in the multiple. The only people still waiting to find out if this works are the rest of us. That leaves one unanswered question: if Anthropic's model depends on becoming the regulated standard for enterprise AI, which governments are already writing those regulations, and who's lobbying hardest to shape them? If you want to know who's writing the rules that could hand Anthropic a monopoly, click the video on your screen right now.